And now, today's speakers, we have Len Pepe. He is not only a Bentley alumnus with a Master of Science in Accounting degree, but also serves as a lecturer in Bentley's accounting department, as well as fulfilling the role of program director for the Master of Science in Accounting and the Master of Science in Accounting Analytics programs. In his spare time, Len is a director of business development at BlumShapiro, bringing more than 40 years of experience in audit and advisory services to clients in a variety of industries. Stephen Bonder, Masters of Tax from 1990, is a partner and industry leader of BlumShapiro's private client and family office group. Stephen focuses on advising privately held companies and high net worth families on business planning and operations, as well as accounting, auditing, and tax planning and compliance. Rounding out the group, we have William Moore Jr., a Master's of Tax from 2017, also a partner in BlumShapiro's tax department with over 12 years of tax experience. He oversees and coordinates tax compliance services for many of the firm's corporate clients. Bill focuses his time on tax planning and the impact of flow-through income to shareholders and owners. So without further ado, please join me in virtually welcoming Len, Stephen, and Bill. Thank you.
So I'll begin, I guess. Emily, thanks for the introduction. And thanks for letting everybody know I have over 40 years of experience. I started as a 12-year-old accountant. So anyway, thanks and good afternoon to all participants to our COVID-19 tax aspects webinar. Once again, I'm Len Pepe and I'm here to fulfill those two roles. One as a Bentley faculty member and one as a BlumShapiro growth strategy assistant in the Boston market. So today we do understand that many of you have attended other COVID-19 type business impact presentations. And we'd like to try to keep this one somewhat conversational and informative, specifically woven around the tax aspects of the relief measures that have been executed by Congress. So it's not every day that you get to have a 1-hour presentation by 3 exciting accountants, but we'll try to keep a watchful eye on this participants' snooze meter and keep it moving by our panelists. So I'll try to bring to the conversation our 2 tax partners at BlumShapiro, Bill Moore and Stephen Bonder. Both are alums of Bentley, as Emily said. And Bill, we're going to start with you on letting everybody know your role at Blum and how we might begin this process.
Great, thanks, Len. I'm Bill Moore. I'm a tax partner, as was mentioned earlier. I spend a lot of my time, especially in the last month or so, on not only the applications for the loan for PPP, but also on advising clients on how we could best maximize amounts. As you can all tell, there's several different provisions related to tax, not specific to the act of the PPP or the loans we'll get into. And some of those require amended tax returns, and it's been a very exciting time. We've made the most of it, and we're fortunate to be able to accomplish most of our normal day-to-day work in this remote environment.
Sorry, I put myself on mute for a minute. Stephen, you're up. Sorry about that.
Oh, thank you, Len, and good afternoon to everybody. It's a pleasure to be here virtually on the Bentley campus once again. I'm fortunate enough to lead the private client and family office group at BlumShapiro, and we're working with high net worth families and entrepreneurs who have built great companies. Obviously, the recent events have caused people to reevaluate how they're approaching business and how they can serve their community. We've spent a lot of time lately, of course, on the Paycheck Protection Program and understanding the tax aspects of the CARES Act and developing tax minimization strategies to take advantage of all the new provisions. So it's a pleasure to be here. Thank you for having us.
Well, great. Thanks to you both for that brief introduction. So let's get this rolling. Stephen, if you could put this all in perspective. I know it's pretty voluminous, and would like to keep it at a 30,000 foot level so that we can not only get everybody to understand top-down situation, but also give some time for some questions in the back half of our presentation. So could you kind of give a first pass as to the federal government's assistance and relief programs to both the American people and to the American privately held and publicly held organizations that we service?
Sure. So Len mentioned, let's take a pass at a 30,000 foot view as to what the federal government's trying to accomplish. As we know, federal government has this magical ability to create currency out of thin air. And they have done that, and they are using three mechanisms to distribute cash back to people and to businesses. So from one methodology they're using is the Internal Revenue Service. And as an example of that is the $1,200 stimulus payment to individuals, or $2,400 to a couple. Bill may touch more on that. So the IRS is one distribution method for this new currency that's been created. The second one is using the state unemployment systems. And we'll see the legislation that is being used to do that. And we've all seen the $600 per month, per week supplemental payment that they're giving to people who are unemployed, and that runs through July 31st. And the third mechanism that they're using is private business, with one program being the Paycheck Protection Program and other tax benefits that's been created through the CARES Act. So let's look at a couple of these things if we can. So let me just flip through these, and as everyone sees in these things, we have our standard disclaimer, and I'm not going to read through that. We need one of those speed readers, which I'm not. And there's our handsome faces.
Even the slides are not showing.
I am sorry about that.
That's all right.
There you go.
Are they now?
Coming.
There we go.
Ah, perfect. Wow.
Now I go back to the disclaimer. I'll give you a second to read that. Don't believe anything you say. Don't hold us accountable. And we'll just get to this first slide. So the federal government has passed what they call 3 phases of legislation so far. The first one was phase 1, which was HR 6074, which was known as the Coronavirus Preparedness and Response Supplemental Appropriations Act. The second phase passed about 12 days later, the Families First Coronavirus Response Act. And the most recent one, which was passed 9 days later, was the CARES Act that we've probably all seen lots on. So the phase 1, the highlights of that were supplemental appropriations to keep various federal departments and agencies funded. There was the telehealth services that people were needing because they couldn't get to their medical facilities. And one of the big items in this first phase was this economic injury disaster loan program known as the EIDL program. And this is an SBA sponsored program. Phase 2 was looking at predominantly extending the Family and Medical Leave Act and the paid sick leave, and then tax credits for companies who were providing these leaves. The third phase, which was the CARES Act, some of the highlights to that are the Paycheck Protection Program, which we've all seen lots of news stories about, the expansion of unemployment benefits, including expanding it to self-employed individuals, direct payments to individuals. This was the IRS mechanism to distribute cash. And then there were some specific individual, corporate, and partnership tax benefits that Bill will talk about, some of which were technical corrections to tax reform of 2017, and others were ways to increase cash flow for companies to help support their operations. So that gives you an idea as to what the federal government has been legislating. Pending now is phase 4, which you may have read about in the newspaper. The House is set to vote on 1,800 pages of legislation tomorrow. And we know that that's going to take a long time to funnel through the system. So we kind of are in a wait and see mode on what the next piece of legislation will be. And you could see that there were 3 quick acts within a couple of weeks. And now we've been delayed for a bit of time. So those 3 acts, I think, are what's in play at the moment. And I'll toss it back now to you, Len, to direct some issues to Bill.
Okay, great, thank you. So right now, Stephen, you're looking at about $2.3 trillion already in the pipeline, ready to go, and it sounds like there's more to come. And there were some real updates. I mean, this is a day-to-day thing, an hour-to-hour thing as far as changes go. So, as both Bill and Stephen said, some of our answers may be somewhat couched because, daily this whole process does change. But so, Bill, you're going to get us into some of the specifics of the CARES Act, and I'll turn it right over to you right now.
Great. Thanks, Len. So again, this was wide sweeping legislation, and I'm going to talk about the provisions that were most prevalent to our clients. And then in the Q&A session, if there's other questions that are more relevant to your business or your individual, please feel free to ask those as well. A lot of the headlines have been on the PPP loan, which was the Paycheck Protection Loan. And we've spent, weeks working with our clients on getting the application done and now getting the money used to maximize forgiveness. So that's something Steve will get into more details on, but that's really the headline of the corporate world. Anyone that could apply for this should have applied for it. And they ran out of funds the first time, so they came back about a couple weeks later and came out with another tranche of money. And that's really supposed to keep these companies afloat for the 8-week period that I think initially was maybe the hope that everything would be back to normal in the beginning of June. Doesn't look like that's going to be the case. So this has been a good start, but at the same time, there are other things that came out there that were intended to increase liquidity. One of those items was the employer deferral of payroll taxes. So, if you're paying your employees, normally there's 6.2% that goes to payroll taxes. They said, okay, if you want to defer that, you can do it. You can defer it until the end of 2021. You got to pay 50% back then, and then the other 50% will be paid back at the end of 2022. So that's a deferral where the PPP loan is permanent forgiveness if the funds are used for the appropriate categories. That was another way to kind of help businesses that might not qualify for the PPP. You couldn't take both, okay? So that was one. Also, as Steve mentioned, due to COVID-19, there's been issues now with businesses being open. So they put in the employer retention credit. Now, what this was meant to do was it was meant to help keep employees on the payroll, right? So a lot of businesses, if they had to be shut down or partially shut down because of COVID-19, they were incentivized to keep their employees on the payroll by allowing up to $5,000 of the first $10,000 of wages to be a credit. Now, this is a payroll tax credit, and obviously credits are better than deferral. So this is something that if you qualified for, you should be taking advantage of. There are 2 restrictions really. Well, it's really just one where it's the size. So if you have under 100 employees, you can be calculating that credit on all of your employees, regardless if they're working or not. If you have over 100 employees, the only employees that qualify for this credit, which is capped out at $5,000 as of now, there are plans to actually extend or increase that dollar amount in the House bill that Steve referenced. If you have over 100 employees, it's only the employees that are not currently working. So those are the 2 main pieces of the CARES Act, not so much tax specific, right? So that's not my day-to-day when I'm focused on my corporate clients and the shareholders. That's more just additional things that were top of mind though, right? This liquidity issue was very important. So we dropped everything in the beginning or middle of March, when I think it came out the end of March, and we tried to get everybody set up with the PPP loans, okay? And we put tax season to the side, but the good news is tax season's still there, and the bad news is tax season's still there. We don't want to be doing taxes in July, but we had to kind of go through what's most pressing for our clients, and it was survival mode. And in this, we've seen the liquidity of the PPP loan help, almost 75 to 80% of our client base. So that's great. But what if you couldn't qualify or wait, there's more, maybe there's something else they might get. So Steve mentioned the technical correction, and this was a big one. It was on the qualified improvement property, and not to get into specifics, but real estate or hospitals or hotel industries might have a lot of improvements if you are doing them to the interior of a structure that are normally classified as 15-year assets. And if it's a 15-year asset, you're able to take bonus depreciation. It's hard to remember what we had for breakfast this morning, but if you go back to the end of 2017, when the last Tax Act was kind of pushed through, it was done very similarly to this PPP process, where they tried to push, 2.5 years worth of work through in about an 8-week tranche. So they missed it, and it was a big one. So if it was classified as a 39-year life, and they needed to do a technical correction to reduce that life to 15 years. They never got around to doing it. As part of this CARES package, they passed it. And what that means is two things. One, for 2019 returns, if we have not filed them, we should be looking at them. But secondarily, and almost more importantly, we got to look at 2018. And we've done that with our clients. We have the ability to go back and make sure that if they had these improvements, we now go, first of all, quantify it, right? We're not going to probably amend an entity return and then shareholder returns for a couple $1,000s, but as many of you probably know from your own businesses, leasehold improvements are significant. They could be millions of dollars, and this is real cash that we can get back to the taxpayers. The only issue with that is the IRS is not exactly at 100% strength. So the sooner you can get those claims in, the better. And this is another way to just maximize liquidity. At the same time, an NOL provision came in at the end of 2017. NOLs, which is a net operating loss from either a business or an individual, normally they could have gone back 2 years and forward. In 2018, they changed that and they said, no going back anymore. You got to just take it forward. As part of this package, they said any NOL for 2018 or 2019 or 2020, you can carry back, not 2 years, but 5 years. And we in the tax world were very excited about this because if you remember, the C Corp rate changed in 2018 from 35% to 21%. So we actually have what we call in the business a rate arbitrage, where we could go back and now take 35% income and offset it. Unfortunately, somebody caught on to that, and yesterday I read in the House bill that they're trying, one of the changes in this next bill is not to allow that to happen, to carry back to a year where the tax rate's higher. So those are a couple of the tax provisions that impact businesses. Along the same time, there was a big alert on all the news stations that said, oh my gosh, there's another loophole now for the billionaires. It's this ability to use these business losses. Most of my businesses are flow through entities. So what that means high level is the income or loss flows through to the shareholders. They pick that up on their personal return. There's methods of accounting that allow us to defer taxes due to various planning ideas that we put into place. Well, in 2018, they said, time out. Going forward, you're going to cap any losses that go through a business return to an individual at $250,000 or $500,000. Meaning if you have a loss of $2 million, you're only going to be able to use $500,000 and the rest carries forward. And you got to look at all of them. So if you own 5 or 6 businesses, you combine them all and those limits are capped at the individual level. As part of the CARES Act, they got rid of it. And it was a big deal. Now basically meaning losses are unlimited. There was one downfall to that. Prior to this change, it was unknown if you could use owner's compensation as a form of income when you're looking at the loss total. So we as accountants thought you could. So we did that. And they were very clear going forward that that won't be able to be used. So that's going to help offset the benefit. But this was a big one that got some traction nationally. Now I saw some of the questions that came out earlier today regards to individual tax provisions. So normally employers can pay about $5,250 of educational costs to employees that is not taxable to the employee. They've changed that and said you can now make direct payments to on student loans for that exact amount, and that won't be taxable. Of course, the person who's having those paid on their behalf cannot now claim that on their personal tax return. There's no double dipping. They've also made changes to charitable deductions. Normally, you can only use 60% of your adjusted gross income if you're an individual, or 10% if you're a company. They've changed that and made it 100% for 2020 and 25% for businesses. So again, favorable changes there, but the question is, with the liquidity issues clients are having, is this going to be a year where charitable contributions are what they normally are? So in a nutshell, those are the bigger provisions that came out of the act. And with that, I think I'll turn it back to Len.
Great, Bill. Thank you very much. Clear and concise. Much appreciated. Stephen, you're going to give us a little rundown on the PPP, the Payroll Protection Program. And again, a good overview and then some specifics, and maybe by after 10 or so minutes, we'll hit some of the questions.
Thanks, Len.
So
So
we want to see your slides again, by the way, they came down.
yes, we don't have any more slides. Thank you. So as Bill mentioned, the Paycheck Protection Program has consumed a lot of time, and particularly at the outset about how to apply for the loan. The banks had to ramp up. They were deluged with applications, and some were more successful than others. But now loan proceeds have come in, and the next big question that companies are facing is, how do I maximize my forgiveness on these loans? And unfortunately, the guidance that was required by the CARES Act to be issued within 30 days of the passage of the act, so that due date would have been approximately April 26th. That date's come and gone, 3 weeks, and we have no clear, specific guidance on how to calculate loan forgiveness. As an observation, we're working with 4 pieces of material: the CARES Act itself, the application that people submitted, the interim final rules that were issued by the SBA, and the FAQs that get published almost on a daily basis by the SBA. And in many areas, all 4 of those items may be in conflict. So it's paralyzed some people about how to proceed. And in many cases, businesses are still up and functioning, and those loan proceeds can be used. And in many other cases, particularly in the hospitality industry, or if there's a government mandated closure, people just aren't at work. And those funds, anecdotally, from bankers, are locked in people's bank accounts right now. They're not spending. Just as an example of the conflicts between the act itself and some of the SBA guidance that we've all been reading about, is the requirement to spend 75% of the loan proceeds on payroll and related costs, and 25% on rent, utilities, and mortgage interest. Nowhere in the CARES Act itself is that mentioned, is that requirement mentioned, yet in the SBA guidance that's been mandated. So it'll be interesting to follow any litigation that may be as a result of these interpretations by the SBA. And it might be that the guidance is delayed because potentially they're thinking about whether or not the objectives of the PPP program can be met and are being met. I think in phase 4 in the proposed legislation by the House, there's several fixes to enable companies to spend money over a longer period of time and help people not just stay on payroll, but to help businesses reboot themselves, which may be a better application of these funds. So there's a lot of confusion, a lot of misinformation, a lot of speculation on how these on the forgiveness calculations themselves and how long companies will have to spend this money. So if you're struggling with it, it's understandable. Our clients are struggling with it, trying to make decisions based upon the information they have at the moment. And as Len mentioned also, this is an hour by hour changing set of circumstances. So we're cautiously optimistic that clarity will be issued soon. And we're happy to, Len, answer any specific questions on that have been submitted, or any tax aspects that have been submitted. So let's open it up to the questions. What's on people's minds?
Just came in that I think are applicable to hit first. You haven't seen them, but I'm going to hit you anyway with them. A lady asked, I think I missed a minute or so of the presentation. Did you mention that you cannot get both the EIDL and the PPP together? Can you double dip in those programs, or is it one or the other?
Well, from the application process, I believe you were supposed to roll into it any idle proceeds that you'd already received. I can't imagine that there were that many idle loans actually issued prior to your applying for the Paycheck Protection Program. Those loans are managed by another group in the SBA, and they were dealing with other issues from hurricanes and other disasters that were around the country. So I personally haven't seen many idle loans been issued. I've seen where the grant piece up to the $10,000 has been issued, and that if you got a grant, that amount reduces your PPP forgiveness calculation. So you can't double dip with respect to the grant. But I'd be curious to know how many idle loans have actually been processed.
Okay.
Yeah,
All
just
right.
to follow up on Steve's point, that's correct. We heard that the SBA website actually crashed about a month ago, and that if you were looking to do that, you could resubmit your application.
Great. Here's another current one that you haven't seen. The question is the stimulus checks. The stimulus check was based on a 2019 tax filing. However, I received a direct deposit for a family member who is now deceased. Should I return the money, and if so, where does it go?
That's a good one. Unfortunate circumstance there. I think the right answer is yes, that we've seen that happen. Unfortunately, a few times. Nationally, there's been a lot of talk about it, but as far as the exact address on how to or where to send it back, I could try to get back to you on that unless Steven happens to know, or Len.
I do not know.
Baffled.
Yeah, they said that this happened on 1% or less, much less than 1%, but when you're talking about the amount of payments that actually went out, it's a big number.
Yeah, I'm sure it's required to, certainly don't deposit it, although it went direct deposit, so it would have to be reissued and drafted out. This is a partnership question, I believe. Are guaranteed payments to owners considered payroll payments?
Very good question. So we struggled with this one initially when we were going through the loan application process, and we thought it was better to ask for forgiveness than to leave this off on the initial loan application. So our advice overall was, if you have guaranteed payments, to include it in the loan amount. Because if you're an S corporation and you have a W-2, that shareholder certainly can use that W-2. We finally got guidance, I think it was 2 or 3 weeks after the initial applications were accepted, that was correct. And just last night, they came out and said, if you didn't include those, there's a way to go back. And I apologize, don't have all the details, but I think you go through the bank and the bank might submit something. So if you did miss out originally, there is a way to get it back, the details of which are just unfolding, as Steve and Len had mentioned. This stuff is very fluid.
Great. Stephen, this is a similar follow-up question. Are health insurance costs for general partners in partnerships included as a payroll cost?
So as we know, partners and partnerships are not considered employees. So the rules are now saying that the partner element of the PPP loan is limited to $100,000. Now, theoretically, included in a partner's self-employment income is the health insurance as part of the guaranteed payment, but it is not an add-on to the cap of the 100,000 like it would be for an employee.
Got it. Great. Bill, here's one for you. I know you don't do a ton of individual taxes, but maybe you can help on this.
Sure.
Does the act affect someone who is on Social Security and has not been paying taxes recently or lately?
Okay. So I think that question means, is there any benefits for me, right? So you're filing a tax return. I do a decent amount of shareholder returns. I think the intricacy there would be, you'd be filing a return, your Social Security benefits might not be taxable, but my understanding would be that you would be able to get that $1,200 or $2,400 stimulus check depending on your filing status.
Right.
Outside of that, the act itself, maybe you're not itemizing your deductions, you're taking the standard deduction. I believe there's now a $300 charitable contribution that you can take. Normally that's limited to people who itemize deductions. So that would be another thing that actually might be able to be taken advantage of. But assuming you have tax, there might not even be tax if that's your only source of income.
That leads into another question, Bill, for you. The additional $300 charitable contribution deduction doesn't change between married filing joint versus single. Is that correct?
Well, that's a good question. I do not think it changes.
Right. Right. Good. Good. Thanks, Bill. Stephen, quickly, here's a question on how to calculate the payroll protection plan loan forgiveness. Guidance seems to vary, as in every question that we have here posed. Guidance is continually varying.
So it is a difficult question to answer because guidance is coming out every day. Based upon what we think we know at the moment, you have this 8-week window from the time your loan is funded to spend the money on designated elements, being payroll and company portion of health insurance and state unemployment taxes. You have your rent, you have utilities, mortgage interest. Those are all amounts that you can use the proceeds to spend and could be forgivable. Another thing you can use the money for, but it is not forgivable, is interest on debt. So then the question becomes, okay, so I got my loan 2 weeks ago. I haven't spent any of the money. What's going to happen? And theoretically, for every week, you have a 1/8 or a 12.5% penalty against what you did spend. So there becomes a point in time where an analysis could be made about, am I better off keeping these loan proceeds, or should I return them because potentially the employee retention payroll tax credit could be a better alternative. In phase 4, the proposed legislation again is addressing this issue. It's trying to expand who is eligible to get the retention credit and how much that credit could be. So it's an interesting problem because you have to balance the two programs and see which might be better for you. The other thing that caused a bit of confusion is this 25% amount that I can spend on non-payroll related items. And I just want to point out that it is not necessarily 25% of your loan proceeds. It's 25% of the forgivable amount. So in essence, you would take your payroll and related costs and divide by 75%, and that would be your total loan forgiveness. And then you would be able to calculate what represents the rent, utilities, and mortgage interest. So again, a very dynamic, fluid, fast-paced situation with lots of unclarity. And as accountants, we hate to give that answer that we don't know for sure. But everyone's in the same boat, and it's a wait and see. Now, I think from an editorial perspective, I think what we're finding is that there may be two classes of borrowers. Those with low loan proceeds less than 2 million and those with loan proceeds greater than 2 million. And we'll continue to monitor how that plays out.
Great.
Yeah, and just to dovetail off of what Steve was saying there, I think if you really want to maximize forgiveness, there's a clear thing that you need to do, right? And that's pay payroll. That's what this was put in place for. So things could change, things will change, but if you pay as much of the loan towards payroll and you keep your employee headcount as close to where it was last year or at the other testing date, that's really the best ways to maximize the forgiveness. There'll be changes down the road. We've been saying that for 3 or 4 weeks, and hopefully they come soon.
Great. Perfect. You go ahead, Stephen.
You know, just to build on that, Bill, the forgiveness penalties can be alleviated if you meet certain benchmarks by June 30. It's a bit of a Hail Mary to get your head counts back up or your salary levels back up, but it's something to monitor. And that's going to be an important thing as to whether or not that date gets extended, particularly for those companies that have been shut down, government mandate shutdown.
Great. Great. You know, technology is so great. I just got an answer by email to the deceased person's receipt of that check. The famous Andrew Wilson, who was a triple Falcon from Bentley University, sent me this email, and he said, Len, answer to the question, if you got a stimulus check and was not entitled to it, i.e. deceased person, the IRS just updated the website with the following answer. You should return the payment as described below. If it's a paper check, write void on the check in the endorsement section, mail the voided Treasury check immediately back to the appropriate IRS location, wherever this person filed their tax return, I assume. Don't staple, bend, or paperclip the check. Include a note stating the reason for returning the check. If the payment was a paper check and you have cashed it, or if it was a direct deposit, submit a personal check, money order, or immediately to the appropriate IRS location. Write U.S. Treasury and write 2020 EIP on the check and the taxpayer ID number of the deceased person. Include a brief explanation and the reason for returning the check. So that's a pretty good answer from the famous Andrew Wilson, and a good friend and a terrific tax partner of mine in the past. Thanks, Andrew. Let's see. So we went over the loan forgiveness. You took care of the, if you receive the $10,000 SBA loan and pay it back within 6 months, what are your tax obligations? You're all set with that. Billy, will the stimulus check be considered income for taxes in the subsequent year of receipt?
I don't think so.
Yeah.
And also, just on that note, if we've seen some issues with 2018 versus 2019, meaning that you're actually allowed to use whatever year would allow you to qualify for it if you do in one and not in the other. And if the IRS for some reason hasn't got that payment out and doesn't get that payment out, there is a way to claim that on your 2020 tax return. I know liquidity is an issue for a lot of our clients and individual taxpayers, but there at least is a way to get it back. There's also a website that's up and running that will allow you to check. I think it might only be up for another couple of weeks too, but there is a way to check on where that is. And if you need to have direct deposit entered, you can do that.
Okay. This is a question that's probably going to be a guess, and it probably belongs in the financial aid department at Bentley University. But the question was, and you probably can't answer it. So will the stimulus payment back to me affect my children's calculated EFC for college financial aid? That's a tough one.
That is a tough one.
But
I would think no.
Right.
Would be my thought. I don't know if you think differently, Steve or Len.
I'll send that over to the financial aid department.
Yeah, I mean, everyone's getting it. I don't know. That's a tough one.
Emily will take that one. How about this one? Would a profit sharing contribution be included in payroll costs for a PPP loan forgiveness? How about the profit sharing plan?
So it's a very good question. And we don't have guidance on that one. My guess would be that if you make an annual contribution to your profit sharing plan, it would not be part of the expenses paid and incurred during the 8-week period of time. For matches, let's say for 401k contributions, company matches, I would think that those would be includable. The other thing that's a bit of a controversy that we're going to be on a wait and see mode as well is whether or not the underlying expenses used and then forgiven, whether or not those are going to be tax deductible. For those tax geeks out there, we saw that the IRS came out quickly and said, no, those underlying expenses used for forgiveness purposes will not be tax deductible. We're not going to let companies double dip. There currently is a piece of legislation at the Senate Finance Committee to reverse that position for this purpose only. So it's a wait and see on that one as well. And that theoretically, if those items are tax deductible, that may change people's behavior on how quickly they spend their PPP loan proceeds and how quickly they bring people back. Business owner will be far more predisposed to bring people back to not do much work and get them off of the unemployment if they're going to generate a tax deduction as a result of doing that. So I think that could really change the landscape a bit if we get some clarity on that.
Good, good. Here's a quick one. Can an employee of a business who took advantage of unemployment also receive PPP funds from their employer? Probably the current employer or the past employer, I would guess. If not, would unemployment be better? I'm not sure you can answer that. That's kind of a double question, Bill.
What I would say to that one, because I'm not totally sure what the question would be, is they did come out and say that if you have employees that won't come back because they are making more money on unemployment or they don't think the risk of coming back is worth it, but you offer them a job back. When you're talking about the forgiveness and the reduction to the headcount that Stephen mentioned, you do not have to include them. I don't know if there's a follow-up, but you have to let somebody know, but that at least was a favorable ruling for the company themselves, who was trying to do the right thing and bring someone back.
That's good. That's the answer. Wonderful. Follow-up question, I guess, to Stephen. If the owners don't get a W-2 for those guaranteed payments, I would assume a K-1 or nothing, would we be able to add these payments to the payroll forgiveness calc?
Right. So the self-employment income that's reported on a person's Schedule K-1 from their partnership are eligible up to the $100,000 cap to be included in the payroll calculation, payroll forgiveness calculation.
Right.
Now, as Bill mentioned, if you didn't include it in your application originally, you can go back and amend your application to try to increase your Paycheck Protection Program loan. And a bit of that is dependent on some reporting that the bank may or may not have made to the SBA. So it's something to do sooner rather than later to amend your PPP loan application.
Okay. I don't expect you to know this one. We have an international student question on a student visa. In the United States, are they allowed to receive a stimulus check, assuming they do not meet the substantial present test and are not a U.S. tax resident? Could they get a stimulus check? I think the deadline for the stimulus checks have passed.
I'm not
anyway.
sure.
Yeah.
I could look that up, Steve. I would think no, but I'm not sure.
Here's one. Do you have any general guidance on calculating how to maximize retention credit versus loan forgiveness?
Well, go ahead, Stephen. I saw you were ready to go.
No, well, I don't know. I was gonna kind of give us a bit of a plug. If you go to Blum's website, we do have a loan forgiveness calculator, a beautifully prepared spreadsheet where you can put in some scenarios and calculate what you think your ultimate loan forgiveness proceeds might be. I think it's a difficult concept to go through right now because there's so many unknowns. At the moment, we don't have our forgiveness calculator tax affected, which could have a significant impact on a company's behavior or spending habits. And how long a period of time are they going to shift it from 8 weeks to 12 weeks to 26 weeks? Or the thing that I'm hoping for is that they'll let you use the higher of the two during the course of 2020. That is, if your retention credits ultimately are higher than your PPP loan proceeds, perhaps they'll say, okay, take the higher of the two and just reduce your retention credit by the amount of forgiven loan proceeds. It wouldn't be fair to have a program where people rushed into making the applications because they didn't want to be shut out, and then find out that there's a tax benefit that they couldn't participate in as a result. So I think there's more to come on that.
Okay, good. We're 10 minutes out. I'll bring in one more question that just came in. Maybe two. Can employer pay out a performance bonus based on first quarter earnings to employees who are on SUI? Will this affect their collection of unemployment benefits? Probably. They get paid a paycheck in a subsequent period in which they're collecting unemployment. I would assume that they would be having to notify unemployment that they got the check, but that's an unemployment department question I don't have an absolute answer to. They're usually pretty liberal, though, I'll say that. Good. And one of the last ones here, to carry back an NOL for 5 years, do you actually have to file 2 Form 1139s?
Are you meaning 2 separate applications?
Probably 1 to 3 years and then 1 to 5 years, possibly. Maybe that's the question. Not exactly sure.
You go back 5 first, and then, you know, if there's NOL left over, you'd come forward to the 4th prior year. I don't know how many years you can fit on one 1139, if that's the question. I thought it was 3, but I would assume you could just attach a second page.
Oh, I see. It's a form
Maybe
question.
that's what they're asking. If you can, if you have an NOL that is so large that it goes back 5, 4, 3, 2, 1, can you do it all on one?
Yeah, they followed up with this and said, yes, a single 1139 only has space for 3 years.
Okay.
So, or expand it yourself or Photoshop it, right? So
do it quickly. I guess that would be our best advice. If you have one that goes back to the 35% rate, we don't know what they're going to do, but you know, the sooner the better for a bunch of reasons. If they change that, well, you might be out of luck anyways, but just the way it's taking, the time that it's taking to get things processed right now, and liquidity being such a hot issue, the sooner the better. Great.
I think, Emily, we're getting close to time, although we have a few minutes left. I don't have any other questions in the question box, but I'll turn it over to you if you think that's good.
That was great, Len. Thank you both. Thank you, all 3 of you, Len, Stephen, and Bill. We are delighted that you could answer so many questions today. Just as a reminder to everybody who attended, you'll receive a recording of this. Thank you for bearing with us through some of our audio-visual hiccups, but mostly we were great. So thanks again for joining us, and hope to see you again on another virtual event soon. Have a great afternoon.
Thanks, everyone.
Thanks, everyone.